A, B, C. Well, that's what most of us have been taught by our fathers on how to cross a street. ABC stands for always be careful. In other words, it means stop and look both ways. Most of us start off that way, but after a period when few cars come and the people who rush headlong get there fastest, caution sometimes is cast aside. This is also true in investing. Most of us learn that it's important to understand a company's business before you buy its stock, and also that it is important to be able to read a company's balance sheet before you decide whether it is a safe investment or not. But when we see others making a good lot of money without reading balance sheets, we also rush headlong to earn quick and easy returns. Caution is cast aside and we are on our way to quick riches through the stock market. But this rarely works, especially in the long run. You must understand a company's business and know how it is doing financially before you invest even 1 rupee into its stock. One of the most important steps in analyzing company's business is by way of reading its balance sheet. In fact, with no knowledge of balance sheet and what makes it good or what makes it bad, you as an investor simply cannot have the resolve needed to do the right thing at the right time. With everyone around you buying and making money, you can't know when a stock is too high and therefore resist joining the party. And with the market in a free fall, you can't possibly have the confidence needed to hold or buy at severely reduced prices. One of the important ways to start reading or analyzing a balance sheet is by being skeptical of what lies inside. In other words, the balance sheet must be read as if the company is guilty until proven innocent. Only this way would you read what really lies inside a balance sheet, which is one financial statement that can be easily manipulated by unethical managers and their accountants. Only a skeptic can separate the things that sound good and are good from the things that sound good but aren't good. Let's now start with a session on how to read a balance sheet. I won't be able to cover all details in this one session, so I will break the analysis into more than one sessions. Let's start with what each item on the balance sheet means and how to know how good or bad the balance sheet is. Here is a balance sheet of Opto Circuits India, a company that we have already discussed threadbare in a few recent posts on Safal Niveshak. Now, since you already know some bad things about this company, as we have also discussed in the recent posts, you are bound to start a die-hard skeptic. But just try and forget what you know about Opto Circuits and start reading the balance sheet with a new pair of skeptic eyes. Let's start now with the first part of the balance sheet, where you see the headline Equities and Liabilities. So we start with Equities and Liabilities. This is commonly also known as the liability side of the balance sheet. But as we have talked about in a previous video, there are not two but three key elements of a balance sheet. One is asset, the second is liability, and the third is equity. So today we are going to discuss equity and liability, which is the rest of the stuff on the liability side, this one. The equation of a balance sheet is, as we've discussed in the past, is assets equals to liabilities plus equity, or equity equals to assets minus liabilities. Let's start with the topmost element of the balance sheet and let me describe each line item as we move down. The first element here is shareholders fund, the shareholders fund, which is also commonly known as equity. So shareholders fund is also known as equity. Equity simply is the money that shareholders have invested in the company, and this broadly takes two forms. The first is share capital, as you can see here, the share capital, and the second is reserves and surplus. Now what is share capital? Share capital is simply the money shareholders invest in a company as per its face value. So assume, let's take an example, assume a company A, so talk about company A. A company A which has 100 shares outstanding, 100 shares. Yeah, the company A has issued 100 shares at a face value. So all shares have face values. It can be 2, it can be 1, it can be 5, it can be 10. So the company A company has issued 100 shares at a face value of 10 rupees per share. So what will be the share capital of this company? The share capital of this company will be 100 shares into 10 rupees of face value, which means rupees 1000. So this will be the share capital of the company. Now you may ask, but in an IPO, companies always price their shares at much higher level than their face value. How do we take care of that price? Yeah, for example, if a company is coming with an IPO, it will not issue you shares at 10 rupees face value. In a bull market, companies can issue you shares at even 10 times book value. So assuming this company has come out with an IPO with a offer price of say rupees 100 per share, right? And we know that the face value equals to rupees 10 per share. Now it might seem that while calculating the share capital of this company, we have to multiply the number of shares by the IPO price, which is rupees 100, which is not true. In fact, the share capital will be, as we discussed above, the number of shares outstanding, assuming the company has issued 100 shares. So share capital will be, the share capital will be 100 into 10 rupee of face value. So the company's face value is 10 rupees. So 100 into 10 rupee face value. But the company has issued shares at 100 rupees. So what takes care of the remaining 90 rupees? Your remaining 90 rupees will be your share premium, right? So share premium will be 100 shares into 90. So this becomes 1000, which will go into share capital, and this becomes 9000, which will go into your share premium account. Now where does the share premium account lie in the balance sheet? The share premium account is part of the reserves and surplus here, right? So you have a share capital which is 1000 rupees raised in an IPO, 100 shares into 10 rupee per share of face value, share capital. Remaining 90 rupees will go into the reserves and surplus where the share premium account lies. So we need to read the schedules. So you need to read schedule 2 of Opto Circuits balance sheet to find out what constitutes the reserves and surplus, and you'll find share premium as one of that. Talking specifically about reserves and surplus, how do you define that? Now reserves and surplus of a company, it refers to the money that the company has either raised as share premium, like we talked about, which is allocated for some future business spending, plus the profits that are reinvested in the business every year after paying dividends. So share capital, reserve and surplus is broadly made up of your share premium plus every year a company which makes profits, it pays dividend out of that profits, and whatever remains is transferred to the reserves and surplus under the profit segment, profit. So it is made up of profit after paying dividends every year. So these are the broad two categories that make a which make a reserve and surplus. These are mainly categorized into surplus part. Reserves are basically allocations that the company makes for specific needs in the future. For example, if company has raised some shares and it plans to buy back those shares, so it needs to allocate some money to share buyback reserve, for example, and it creates a reserve and allocate money for a future specific need. So that's reserve. Surplus is what is surplus with the company every year. One is profit, and the another is share premium, which the company receives as premium in its IPO or in a future subsequent issue of shares. In simple words, reserve and surplus is the money that the company has set aside for a specific future need. So these money as you see, which around 145 crore rupees. Yes, it's around 1457 crore rupees. Opto Circuits has set aside as reserve and surplus. So both this money together, you have 242 crores and 1457 crore, which totals your 1699 crores roughly, is your shareholder equity, shareholder funds, or also equity, which is a total of what the shareholders have invested in the business. You as an investor might not invest the entire amount, in the sense when you are applying to an IPO, you are actually investing via share capital, and your premium that you are paying on the IPO price is going towards the reserves, surplus, sorry, And reserves is actually the company, the profit which remains after paying dividend is added to the reserves. So it's ultimately a shareholder's money. That's the reason both these things, share capital and reserves and surplus, are categorized as shareholders' funds. Next in line is minority interest. Minority interest is a figure which is seen only in case of consolidated balance sheet of a company. For example, if a company has subsidiary or a few subsidiaries, then it will have to prepare a standalone balance sheet which only showcases its own standalone business assets and liabilities. Plus, it also needs to create a consolidated balance sheet where it consolidates or adds the balance sheet or adds the assets and liabilities of its subsidiaries, and then gives out a complete picture. So if a company has subsidiaries, it's always good to look at its consolidated balance sheet. And minority interest is a figure which will always be in a consolidated balance sheet only, not in a standalone balance sheet. This number, which is minority interest, it refers to a subsidiary company stock that is not owned by the parent company. So let me show you with an example what minority interest actually means. So for the lack of space, I'll just write over here. As an example, assume Tata Steel owns 80% of Chorus, right? So Tata Steel owns 80% of Chorus, right? This is what you're assuming, and Chorus supposedly this year Chorus earns around 100 rupees of profit, right? Total profit. Now 80% belongs to Tata Steel, but 20% belongs to minority shareholders, right? So you have Tata Steel, which when preparing its consolidated balance sheet, consolidated profit and loss account, will show 100 rupees as a profit of Chorus, but when it will also deduct something called as minority interest. Before coming to the net profit, it will deduct minority interest, which is 20 rupees. So 20 rupees belongs to the minority investors in Chorus, right? So that figure adds up over a period of time, and it is shown as minority interest in the consolidated balance sheet. Now you're seeing a figure in Opto Circuits consolidated balance sheet simply because Opto also has some subsidiaries where it does not own 100% of them. So it shows a minority interest in the balance sheet. This is not a very meaningful number while analyzing a balance sheet. So if it's a marginal number, you can anyway skip this number while analyzing the strength of a balance sheet. What is meaningful now is what we are going to read next, which is the non-current liabilities part. Here you have part 3, right? So we are reading the non-current liabilities after understanding what minority interest is. Now non-current liabilities, as you see, is made up of 3 segments. A is long-term borrowings, B is deferred tax liabilities, and C is long-term provisions. Let's understand what these 3 means. First, A, long-term borrowings, clear from the name. It represents the total face value amount of long-term bonds issued by the company, or it indicates loans that the company has borrowed from banks for a long term, maybe for 3 years, 5 years. Anything above 1.5 years is considered, any borrowing which is made for a longer period like this than this is considered as a long-term borrowings, and it is shown as long-term borrowings in a balance sheet. So if you see, Opto Circuits has around 296 crore of long-term borrowings in the balance sheet, which it requires to fund its growth, expansion, whatever, but it has some amount of long-term borrowings in its balance sheet. Now the reason this number is critical is it shows how much debt burden a company owes in the long term. Companies that owe a lot of money in the long term are bad businesses, which can face tremendous pressure when business is slow, and they still have to pay interest on these borrowings. So if you take a loan, assuming you take a housing loan for yourself, and if you lose a job, you still have to pay the EMI, right? You can't create an excuse and say to the bank, I've lost my job, so I can't pay an interest EMI. In the same way, when companies borrow money, they have to pay interest, whether it's a slowdown, whether it's a good period, they have to pay a fixed amount of interest every time. That's the reason companies that have debt on their balance sheets companies that have a lot of debt on their balance sheet are not considered safe investments, because in case there's a slowdown, they still have to pay interest burden, and their profits will even shrink further. So as we see, Opto Circuits has 296 crore of long-term borrowings. Now whether it is high, whether it's low, we'll understand now. Question is, how do you know how large the borrowing is, right? So for instance, for a company, rupees 100 crore of borrowing can be large, and for another company, even rupees 10,000 crore of borrowing can be very small. So how do you find whether the borrowing is big or small? The best way to do this is by calculating a ratio called debt to equity ratio. So we calculate a ratio called the debt to equity ratio. So the debt to equity ratio. What is it, debt to equity ratio? As we see in the balance sheet, one is the company has long-term borrowings, so it's long-term debt, and if we come a bit down, there's something called a short-term borrowings, right? So this is short-term debt. So either you can calculate long-term borrowings to equity, or you can calculate short-term borrowings to equity to see the relative picture, or better, if you want to get an overall idea of the debt burden on the balance sheet, you must calculate the long-term borrowings plus the short-term borrowings divided by the equity of the company. So let's calculate what's the debt burden of the company. Yeah, so as I see, the long-term borrowings around 296 crore, and the short-term borrowings, as we see, is around 764 crore. So this figure is short-term borrowing, right? So 764 crore. So what's the answer? The answer is around 1060 crore, right? So if we come down, if we calculate debt to equity ratio of Opto Circuits, it's 1060 crore of total debt divided by equity. Now what is the equity figure? The equity figure is given here, as we said, 1699, which means 1699, which is 1699 equals to, so if we calculate 1060 divided by 1699, we get a figure of 0.6 times, right? So the debt equity ratio is 0.6 times, 0.6x or 0.6 times is the number. Any number which is closer or higher than 1 time is dangerous number. So if a company, if Opto were to have a debt of around 1700 crore, which means the debt is 1700 crore and equity is almost 1700 crore, which means the ratio would have been 1:1 or 1x. That would have been a dangerous number. Even 0.6 time is not a very comfortable number, but yeah, a company with a 0.6 time debt can do reasonably well by paying off that amount of debt in the future. But a company which has a one-time debt or more than that compared to equity can have a serious problem by repaying debt. So looking at Opto's number, the company is not so bad as far as the debt equity ratio is concerned. But that's not the end of it. There's another ratio that will show a better picture than the debt equity ratio. It's called the debt burden ratio. Yeah, so it's called the debt burden ratio. Now what's the debt burden ratio? Debt burden ratio is simply your debt divided by the FCF. FCF is the free cash flow of a company. Now the question is, how do we calculate the free cash flow? Let's go to the cash flow statement of. So this is the cash flow statement of Opto Circuits. Now how do you calculate the free cash flow? Just above point number 2 in the cash flow statement, which is here, you can see something called as net cash flow from operation, right? So it's around 126 crores of net cash flow from operations. This is the cash that the company has generated from its operations during the year. Now how is this number calculated? We will see in another video on cash flow statement in the future, but for the sake of calculating free cash flow as of now, let's just take this number of 126 crore, right? So we take a number of 176 crore. So you have FCF, sorry, when you calculate FCF, you have a number of cash from operations which is 126 crore. You have to reduce something called as purchase of fixed assets. Now where do you get the purchase of fixed assets? The purchase of fixed assets lie a bit lower here. Purchase of fixed assets, which is around 324 crores, right? So 324 crores of purchase of fixed assets. So you have 126 crore of cash from operations minus 324 crores of purchase of fixed assets, which means the number is a negative 198 crore. So your free cash flow for Opto Circuits for latest year 2012 2011-12 was a negative 198 crore, which means it burnt so much cash, free cash, during the year. So how do you calculate the debt burden ratio? Now you have debt of the company which is 1060 crore, and you have your free cash flow, which is minus 198. Now this number be a negative number, so it's not valid, and it shows that the company is in a dangerous situation because its free cash flows are not there to pay off its total debt burden even over the next few years. A good number, now you'll ask, what is the good number for companies? What is the debt burden ratio? Companies that have sustainable modes generally have a debt burden ratios of less than 3 times, which means a company's debt must not be more than 2 to 3 times its annual FCF. So assuming your free cash flow is positive 100 rupees, your debt on the balance sheet should not be more than 200 or 300 rupees. If it's more than that, there are some concerns that you must have with respect to the company. Anyways, coming from short-term borrowings, coming from long-term borrowings to deferred tax liabilities. This is one line item which is again not there in all balance sheet, but yeah, these days there almost. Now, what exactly is deferred tax liabilities? Just a second. Yeah. So, what exactly is a deferred tax liability? In simple words, this is a tax liability that a company owes and does not pay at that current point, although it will be responsible for paying it at some point in the future. So you have provision for taxes, which means the taxes which the company has to pay in that very year, and you have deferred taxes, which means the company has to pay a deferred tax liability which the company has to pay sometime in the future for sure. In simpler words, deferred tax liability is like a provision for future taxation, and it arises due to timing differences in the value of assets as per the balance sheet and as per the income statement. So depreciation is the main reason for creation of a deferred tax liability. Now, if it sounds a bit tough, let me help you with an example. Let me explain. Suppose a company purchases a car, right? So a company purchases a car. Let me draw a car. Pardon me for my bad drawing. So a company purchases a car, and assuming the car's value, it is say 10 lakh rupees, right? So the car value is say 10 lakh rupees. Now, as per Companies Act, the company can claim a 20% deduction. So, Companies Act, pardon me for my writing as well. A Companies Act allows company to claim depreciation at 20%, which means it can claim a depreciation of rupees 2 lakh. So, rupees every year, right? Now, there's another act, which is the Income Tax Act. Assuming, as per the IT Act, the depreciation that the company can claim is at say 40%, and there's normally a difference between the depreciation rates as per the Companies Act and Income Tax Act. So, at Income Tax Act suggests that the company can claim a depreciation of 40%, which means company can claim rupees 4 lakh of depreciation. What is the difference between the two? The difference is minus rupees 2 lakh. Now, if assuming the company's IT income tax rate is company's IT income tax at rate at which it pays income tax is say 30%, right? So your deferred tax liability will be 30% of 2 lakh, right? Which will be equal to rupees 60,000. So this will be the deferred tax liability. Now, what the 60,000 of deferred tax liability means? This means that the company will definitely have the tax liability of that much, which means 60,000 in the future years. In case the difference here, if assuming it was not negative, it was a positive number, then the deferred tax would have been a positive 60,000, and it would have been called a deferred tax asset in the company's balance sheet. Now, if you look at Opto Circuits has a deferred tax liability of 0, which means, and it had a deferred tax liability of around 23 crore last year, which means it has paid off its entire deferred tax liability, and it has a nil deferred tax liability in the current year. This is also not a very meaningful number while analyzing balance sheets, but yeah, you should always have an eye for this number. The third segment of non-current liabilities are long-term provisions. This is simply the amount a company sets aside. It's an easy definition. It's simply an amount which the company sets aside for provision of things like leave encashment. So if there's a leave encashment coming in the long term, There's gratuity payments coming in the long term. There are product warranties that the company may have to pay in the long term. So the company creates provisions for that. And you see there are a lot of provisions because Opto Circuits is in a medical device businesses. So it has to give a lot of warranties to consumers, which may be big hospitals and all those kind of things. So there has to be some provisions that the company has to create in its balance sheet, which is a liability. So if warranties are triggered in the future, the company has to pay. It might not have ready cash then, so it's always good to have a provision created in your balance sheet, which the company has done via long-term provisions. Now let's move to the fourth segment of the liability side, which is current liabilities. Current liabilities are often understood as all liabilities of the business that are to be settled in cash within the next 1 year or the operating cycle of a given firm, whichever period is longer. But a better definition is that current liabilities are obligations that will be settled by current assets or by creation of new current liabilities. Let us understand this by looking at constituents of what constitutes the current liabilities of a company. As you can see in Opto's balance sheet, the first subsegment is called short-term borrowings. So you have short-term borrowings. Short-term borrowings, which is the first segment of the current liabilities. So as the name suggests, a short-term borrowing is usually a bank credit line that needs to be paid off in a short amount of time, like within the next 1 year. This borrowing is usually made to meet the daily operations of a company. Or in other words, this borrowing is made to meet the company's working capital requirements. Now what is working capital we'll discuss in a subsequent video when I talk about the asset side. Let's now focus only on the short-term debt that is there. The value of a short-term debt is very important when determining a company's financial health. If this number is larger than the company's cash, now if you see the cash number, so if you see the cash number, it is around 17 crore rupees. It's around 174 crore rupees for Opto Circuits. And if you see the short-term borrowings, around 764 crore rupees. So if your number of short-term borrowing is larger, which is true in case of Opto Circuits, than the company's cash, this suggests that the company may be in poor financial health and does not have enough cash to pay off its short-term debts. So as we saw, in Opto's case, the short-term borrowings stand at 764 crores, and the cash that the company has in its bank is around 174 crores. Which is a big deficit of around 700-800 crore rupees, which means company has more short-term borrowings than the cash to support on its balance sheet. Now this is concerning, despite the fact that the company's total debt to equity that we discussed was just 0.6 times. So debt to equity in isolation does not give a complete picture. If you see the short-term borrowings minus the cash, if it's a positive figure, which means your short-term borrowings are higher than your cash, there can be some concerns on the liquidity within the company. So here's another important number you must look at while analyzing the balance sheet after short-term borrowings. The next number is trade payables, right? So what exactly is a trade payable now? These are also known as account payable, and it's the money owed by the business to its suppliers. Suppliers, people who, for example, in Opto's case, people who might be supplying him raw materials or semi-finished goods, they are suppliers, and they're also known as creditors. Like in our household, the accounts payable are ordinarily bills from electric utilities, the telephone company, the satellite dish service company, the newspaper that we buy, and other such regular services. We consume them now and pay for them later. So that's the reason there's accounts payable. In the same way, businesses consume raw materials or semi-finished goods now and pay for them later, mostly over a 2 to 3 month period. Now, how do we know the health of a company based on the trade payables? A ratio that helps us understand how good or bad a trade payable number is called the creditor days, right? Which estimates the average time it takes for a business to settle its payments with suppliers. So you have something called as the creditor days. So yeah, you have something called as the creditor days. Now how do we calculate creditor days? The ratio is, you have your trade payable divided by your cost of goods sold. So it's also called COGS into 365. That's the number of days in a year. Now cost of goods sold, the trade payable number is already there in the balance sheet of Opto Circuits. It's there. The trade payable number is here. Now what about the cost of goods sold? Where do you get the cost of goods sold from? The cost of goods sold is a number you can calculate from the P&L account, which we will discuss in the future video. In simple words, cost of goods sold is the direct cost which are attributed to the production of the goods sold by a company. Now this amount includes the cost of raw materials used in creating the good, along with the direct labor cost used to produce the good. Of course, it excludes indirect expenses such as distribution cost and selling and marketing cost. Now for simplicity purpose, you can use sales in the denominator for calculating creditor days. So instead of cost of goods sold, I can use, say, sales to calculate my creditor days into 365. In Opto case, the numbers are, now if you were to look at the Opto circuit number, you'll have trade payables. You have trade payables which is 206 crore. So let's calculate. So you have 206 crore of trade payables, and if I were to look at sales, I have some sales figure here. So if I were to look at the sales figure of the company, which is 2357 crore, so if I were to say divide by 2357 crore, this number, and I multiply this by 365, which gives me a number of 31. So my creditor days for Opto circuits will be 31 days, right? Now is this number a good number or a bad number? This I think is a comfortable number in the eyes of a creditor, since it shows that they can expect the payment from Opto circuits in a month's time. Now from a company's standpoint, the higher the number, the better it is, because all companies want to conserve cash. At the same time, a company that is especially slow in paying its bills, for example, it takes around 100, 120, 150 days to pay off its creditors, may be a company having trouble generating cash, or one trying to finance its operations with the supplier's funds. So it's very important to look at this number. From a company's standpoint, if the number is higher and the company is sustaining that higher number for a long time, fair enough. From a creditor's point of view, higher the number of days, they might have concern in terms of dealing with the company. But if the company is able to sustain for a long period of time with high creditor days, which means the suppliers don't have such a kind of bargaining power. In case of Opto circuits, the company is paying sub creditors well within a good amount of time, which is 31 days. After trade payables, now let's look at the third sub-segment of the current liabilities, which is other current liabilities. Now you cannot tell what other current liabilities are actually without looking at the schedules. Now you need to look at Schedule 8 in the balance sheet, which I am not covering currently. So if you open up the annual report of Opto circuits, you'll find in Schedule 8. So let's see, let's find out the Schedule 8. So if you see the Schedule 8, you'll find liabilities like interest income received in advance. So there might be customers who might be paying in advance. There's some unpaid dividends, there's unclaimed dividends, there's some other dues which are payable, there's current maturities of long-term debt. So if a company has, so for example, Opto is about to pay some kind of its long-term debt in the near future, that will also come in other current liabilities. So we need to understand, we need to read the schedule to understand what exactly is the long-term, short-term liability that the company, short-term current liability that the company has to pay. So coming back to the annual report again, the final figure that we have on the liability side is short-term provisions. And again, by the name of it, we know it's provisions, but what exactly it constitutes, you need to read the schedule. Now if you go and read the Schedule 9 of Opto Circuits annual report, you'll see the short-term provisions is made of near-term leave encashment. So leave encashment which is coming very near. You have some near-term gratuity payment or some warranty payments, or even the proposed dividend for that year. So the company makes short-term provisions for that. So that is all which is a part of short-term provisions. These are the amount the company has set aside for specific needs that will arise in the near term within a year. So this was an explanation of different line items in Opto Circuits balance sheet annual report in the liability side. I've actually looked at, I've actually created an Excel sheet which contains the past 9-10 years of the balance sheet numbers, some key balance sheet numbers, and how do we identify trends from them. So we'll start from the top, which is the share capital. We've already discussed the share capital is the money, is the face value of shares multiplied by the amount of shares that the company has issued. So as you see, the company has consistently seen an increase in the number of share capital, which is a concerning sign, which means the company has consistently diluted equity. More shares are coming out in the market, which means your earnings are not increasing, because just increasing the number of shares or issuing more shares does not mean that you are increasing your earnings as well. So if you see, if you calculate the earning per share, while your numerator, which is the earnings, will remain constant or it might increase at a slower pace, your denominator, which is the number of shares, is increasing rapidly, which means existing shareholders will see a dilution in their earnings. So when you see a rising share capital on a consistent basis, it's a concerning thing. Now the impact of this rising share capital, as we discussed, the face value amount goes in the share capital, but there's a premium amount which goes in the share securities premium or share premium account. So you can see the consistent dilution. So there's a consistent addition to the securities premium account as well. Another segment of reserve and surplus we talked about is the retained profits, the profits which are not paid after, or profits which are remaining after paying dividends. So they are added back to the profit and loss account balance in the reserves and surplus. This is a surplus for the company. So this is also increasing, which is a good sign again. And then you have some general reserves which company creates for meeting future contingencies or future expenses. So that was the total, and we said total shareholder equity is equal to share capital plus total reserves. So if you see the formula, it's share capital plus total reserves, so which is increasing. Now a reason it is increasing is because the company is also raising shares, issuing shares on a regular basis, so raising money from the public and diluting its equity, which is the concerning side. The positive thing is it is able to increase profits at a rapid pace as well, helped by acquisition, of course, which we'll cover later. So that is adding to shareholders' equity. Now if someone were to ask you, or you were to calculate the book value of a company, book value is nothing but your shareholders' funds divided by the number of shares. So for this company, for example, if I were to calculate the book value, so book value will be the shareholders' equity, which is 1699, divided by number of shares. So it has around 24.2 crore shares, which is 70.128. So this is the book value per share of Opto Circuits. Coming back to the liability side, we saw minority interest. Again, it's increasing because company has made acquisitions. So all the minority interest share in profits is added to the minority interest, not a meaningful number. Meaningful numbers come here again in the balance, in the debt side, the borrowing side of the company's balance sheet. Now you might see something called secured loans, unsecured loans, while in the balance sheet you saw something called as long-term borrowings and short-term borrowings. This is a new format. What you are seeing in the annual report, it's a new format that companies have now creating their balance sheets in. The earlier format was not like this. Earlier format was talking about whether a loan is secured or unsecured. Now it's about whether a loan is long-term or short-term. So I have taken the old format and I have taken the numbers from the schedules of long-term and short-term borrowings and calculated how much is secured loans and unsecured loans. Secured loans is simply the loans that you take against some property or any mortgaging any property, those kind of things. And unsecured are simply short-term loans which you just borrow from banks. So as you see, the loan figure, concerning part is the loan figure is increasing. From 94 crores straight away jumped to 536 crore because the company started making acquisitions. Then in March 11 it was like 800 crores of the total loan value in the company's balance sheet was 800 crores and then 990 crores. So this is concerning. Another concern, biggest concern, is why is this number rising? The number is not rising because the company is taking long-term borrowings. If you see, of course it rose from 39 to 298 crore here, but then it's almost stable or there it is. But when you see the working capital loans, 242 crores it reduced, but then the working capital loans for the company has increased. Working capital loans mean the loan that a company needs to take for meeting its working capital requirements or daily operational requirements, which means the company is not generating adequate cash to meet its own working capital requirements and it has to resort to taking working capital loans. So this is a concern, and this is unsecured loan. So total loan comes to around 1061 crore for the current year, which is on a rise. Now if, as we said, if I were to calculate the debt equity ratio, now assuming I'll just calculate in front of you. So if I were to calculate debt equity ratio, total debt will be 14 crore divided by equity, which is 30 crore, so 0.5 times. Now if I were to carry it forward, see the next 10 years trend, it's like 0.3, one time it increased, now gradually declined, then again it's increased because of acquisitions, and it's 0.6 times, which is a comfortable number. The second number, which is the more important number we discussed, was debt burden ratio, which is debt to FCF. Now debt to FCF number, if you see, now FCF, we've calculated FCF. I've also calculated FCF here using the formula of cash from operations minus purchase of fixed asset, which is the FCF number. The FCF number has depressed a lot in the latest year. It was negative last year as well, and that's the reason it's very difficult to calculate DCF value of this company. But it has really worsened a lot in 2012, and if you calculate debt to FCF, as we saw, it's a negative number, so it's not really valid, which means there's a concern in the company as far as its debt burden is concerned, despite the fact that its debt equity is not high. And we also discussed the third parameter, which is the short-term borrowings minus cash, the net debt figure. I've taken the total borrowings minus cash, and you see there's a big deficit. So your total borrowings is higher than your cash by around 887 crore, which is a concern. Coming to the current liability side, the trade payables, we discussed this is the amount of money that the company has to pay to its creditors, to its suppliers, and we talked something about the creditor days. And if you see, current creditor days around 32 days, but it has been higher in the past, which means the creditors are receiving money faster from Opto Circuits now than in the past. Good sign for creditors, a bad sign for Opto Circuits, because it has to pay money to its suppliers in 30 days. If it was supposed to pay in 90 days, that was the amount of days it can have held the cash on, and it have funded its working capital. Now it has to pay in 30 days, which is a concerning sign. We calculated the sales. This figure will come. This figure was used to calculate the creditor days of the company. So this was a basic analysis of the liability side of the balance sheet of Opto Circuits. Overall, the balance sheet is extremely important, as I've always maintained, in determining how financially sound a company is. It also shows you how much capital the company needs to generate its profits, which is critical to calculate the return on capital. As they say, to know how good a job a manager did, you have to have a good idea how much risk he took. In the same way, to know how good a company is doing, you have to have a good idea how much risk it is carrying on its balance sheet. And the liability side will tell you that very clearly. In a next video, I'll talk about the asset side of a balance sheet and explain you line by line what exactly each of these items like assets, fixed assets, goodwill, current assets, inventories, what all that means. That's all from my side today. I hope I've been able to clear your doubts on the balance sheet in some way, and especially on the liability side. We'll talk about the asset side soon. That'll cover up the entire discussion on how to analyze a balance sheet. For the time being, understand that the liability side, or the money that the company owes to whether equity holders or banks or financial institutions in terms of loans, is a very critical side of the company's balance sheet. It really gives you an indication of the true health of a company, whether the company has high amount of debt. As I discussed, debt equity in isolation does not matter. Debt burden, which means debt upon free cash flow, matters a lot. So we need to calculate all these simple ratios, and within 5 minutes or in a short span of time, over a period of time as you practice, you'll be able to judge whether the company has some risks on the balance sheet, whether these risks are sustainable. For that, you need to see the long-term trend, and as we see from Opto Circuits, that risks have really increased over the past 2-3 years. And the concerning part is the management is not really speaking out in terms of what it plans to do in the future and how does it wants to lower the risks. So these are some concerns that balance sheet will throw in front of you. Of course, it's very important to read the schedules and then take a deeper look into what exactly lies within these numbers. So that's all from my side today. Have a nice day. Thank you very much.